I think about the fundraising environment 4 or 5 years ago where capital was easy to come by, interest rates were super low, it was easy to put debt on. We've seen companies that have been incredibly acquisitive and backed by large private equity firms and bought 5, 7 companies, grown to 500 million plus, and then having to carve out and sell off assets because they're missing their covenants. And there's obviously realities associated with that. And then I also think about PE firms that have certain marks on paper that show that an asset is worth X amount of dollars, but in reality, today that asset would not trade for that same amount, right? And I would imagine LPs are seeing that across the board. So how are LPs balancing that need from like, okay, we definitely need to find a differentiated capital allocator, but it turns out that a lot of people that we've bet on are also facing similar realities because it's also a macro trend. So how are you seeing that in the market?
One way we're seeing that just general challenge manifest is that fundraising is taking a lot longer than it used to. LPs are taking more time, being more deliberate about where they invest their capital. The supply demand imbalance, first of all, has never been wider. More GPs in the market, fewer dollars to go around. LPs are committed to the asset class long term, right? How we're seeing that manifest is the dispersion of outcomes in fundraising has never been wider between the sort of top performing firms and then sort of everybody else. The average fund right now is taking 20 months to get raised. An interesting stat from last year, 30 to 40% of the funds that closed last year were in the market for 2 years or more.